Welcome to HS Tutorial, an online tutorial for students, and I am your tutor Olamide. I will be taking you through accounting for depreciation today according to the standard IAS 16, which is accounting for property, plant and equipment, and IAS 38, which is accounting for intangible assets. And the three things that I will be talking about today is methods of depreciation. The second one is the revision of the residual value and or useful life, and the third one, the accounting entries for depreciation. So now, what does depreciation means? According to IAS 16, depreciation is the systematic allocation of the depreciable amount over its useful life. That is the depreciable amount of an asset over its useful life. What does depreciable amount means? Depreciable amount means the cost of an asset less its residual value. Depreciable amount less its residual value. So the definition says cost less residual value, then over what? Over its useful life, all over its what? Useful life. So instead of you writing useful life, you can also say estimated useful life. So what does this mean? It means that the cost of the asset will have to deduct the residual value. What does residual value means? Residual value means the amount which an asset will be disposed of after the useful life has been completed. Okay, so it means cost less any scrap value, that is the amount you are going to spend after the useful life has been extended all over the useful life. So this is the generally acceptable definition for depreciation. So now let's move towards explaining the methods of depreciation. We have several methods of depreciation. We have straight line method, we have diminishing method. That diminishing method, you can as well call it reducing balance method. You also have some of the year digits. You have depletion revaluation method, and so on and so forth. But basically in this video we'll be talking about just two methods, as these two methods are the most popular method which is being used by every organization, or if you are in an exam condition, that is what they are likely to bring. Okay, so that is the straight line method and the reducing balance method. What is the formula for the straight line method? This is actually the formula for the straight line method. Okay, then the formula for the reducing balance method. Okay, is actually R equals to 1 minus n truth of the scrap value all over what? All over the cost of the asset, open and close bracket, multiply by 100 all over 1. So now let's start with just one question. So we have some questions for you here that we can actually solve for better understanding. So the first question is, Soft Study Nigeria Limited purchased a motor vehicle on 1st January 2001 at the cost of 150,000 naira, and the motor vehicle is expected to be used for 5 years. So these ones are the options that are available, right? The first option is solve when there is no residual value. The second one is solve when there is 30,000 naira residual value. Then the third one is solve when there is 30,000 naira residual value but using reducing balance method. There is something I want to point your attention to as well. That is, if the examiner did not mention that use any of the methods like straight line method or reducing balance method or any kind of method like that, so what you will have to use is the straight line method, since they didn't talk about you using any kind of method. So the method that you will use is the generally acceptable one, which is the straight line method. So now let us solve the number one question. Okay, so we'll first of all write the formula. We have to write the formula. What's the formula for straight line method? This first one, you are actually using the straight line method in solving this. So what is the formula? The formula is cost less residual value. I'm representing the residual value with RV. Then I'm representing the estimated useful life with EUL. Okay, so now let's solve. What is the cost according to the question? They said self-study bought a motor vehicle for 150,000 naira. Okay, so the cost we have to be what? 150,000 naira. Less means minus. What's the residual value in the first one? In the first question, they said there is no residual value, so that will be 0, right? All over. What's the estimated useful life? The estimated useful life is what? Is how many years do they tell you to solve that? How many years do they mention that this motor vehicle will be used for? It is what? 5 years. So you will have to represent the estimated useful life as 5. So what are you going to have when you minus 150 with 0 from 150? So you will have to have 150,000 naira all over what? 5. If you pick your calculator and solve this and say 150,000 naira divided by 5, what would that give you? It will give you what? 30,000 naira. So you have actually solved the first question. So now where that is where there is no residual value. Then the second question, let's solve. The second question says Self-Study Nigeria Limited purchased a motor vehicle on 1st January 2001 at the cost of 150,000 naira, and the motor vehicle is expected to be used for 5 years with 30,000 naira residual value. You repeat your formula. Okay, what's the formula? Cost, okay, less residual value all over EUL, that is the estimated useful life. Okay, so the estimated useful life. So what's the cost of the assets? We have 150,000 naira minus the residual value. What's the residual value? They've given the residual value to be what? 30,000 naira. Okay, so we can now say the residual value is what? 30,000 naira all over. Then the number of year is what? 5, right? So 150,000 naira minus 30,000 naira, what would that give? It will give us 120,000 naira all over what? All over 5, right? So now 120,000 naira divided by 5, what would that give? It will give us 24,000 naira. So it means with residual value of 30,000 naira, the amount of depreciation we have to reduce to what? To 24,000 naira. So it means this 24,000 naira will now be the amount that will be charged every year till the end of the 5th year. So that's that on that. So now let's move to the next question, which is Self-Study Nigeria Limited purchased a motor vehicle on 1st January 2001 at the cost of 150,000 naira, and the motor vehicle is expected to be used for 5 years with what? 30,000 naira residual value using the reducing balance method. So the first thing you will have to do in solving this question is for you to write out the formula. What's the formula for the reducing balance method? It will be R% equals to 1 minus the nth root, okay, of the scrap value all over what? The cost multiplied by 100. Okay, so it will now be 1 minus what's the nth root? N represents the number of years. So what's the number of years? We have 5 years. Okay, then the scrap value. What's the scrap value in the question? It is what? 30,000 naira. 30,000 naira. Okay, so all over, what's the cost of the asset? The cost of the asset is what? 150,000 naira. Okay, so multiply by 100. Okay, so what you would just do here is to say 1 minus fifth root of, now you can now solve what is in the bracket. So how do you get what is in the bracket? You can just say 30 divided by 150. What will that give you? To give you 0.20. Okay, so open and close bracket again, multiply by 100. Okay, so now you can now say the fifth root. How do you get the fifth root on your calculator? Okay, you first of all say 1 minus the fifth root of 0.2 will have to be 0.72. Okay, actually I have approximated this. 0.72 multiplied by what? 100. So you can now say 1 minus 0.72. What do you have? 0.28. I approximated this as well. Okay, this has already been approximated. 1 minus 0.72 we have to give you 0.28. Then multiply by 100. So it will now be turned to what? To a percentage. So it means the R% from the beginning. Let's pick it from the beginning again. So the R% will have to be what? 28%. Okay, so now since we have gotten our 28%, it is now this 28% that will now be applied to the cost of the asset for you to get what the depreciation of the asset will be. So now let's start year 1. Okay, so what is the cost of the asset? The cost of the asset is what? 150,000 naira. Okay, then what do? You apply this 28%, which is the depreciation rate. Okay, of what? 28%. So 28% of 150,000 naira will give you what? 42,000 naira. Okay, that 42,000 naira you will have to deduct it as well from the cost of the asset for you to get your what? Carrying amount. Okay, so now for you not to like be searching for what the depreciation is, the best thing for you to do is to bring out the depreciation as you are solving. Bring out the depreciation amount as you are solving. So what is the depreciation amount here? We have 42,000 naira. Okay, so 42,000 naira. When we deduct 42,000 naira from 150,000 naira, what do you have? You have 108,000 naira. Okay, so this is our new carrying amount. For you to get your year 2 depreciation now, you will still have to apply the 28% depreciation rate to the carrying amount now. So now 28% of the 108,000 naira will give you what? 30,740. Okay, so you can now deduct your 30,740 from the 108,000 naira. So what will you have? You will have 77,760. But before you move further, okay, you will have to do what? You will have to bring the 30,740, which is your depreciation, out so that you won't mix it out or you won't take time to be searching for it. Then now this is now your new carrying amount. So I will have to be representing carrying amount with what? With CA. So now for you to get the depreciation for your year 3, okay, you will have to write depreciation, then you apply the 28%. The 28% of 77,760 will be what? 21,773. So when you deduct 21,773 from 77,760, what will you have? You will have 55,987. That's approximation. 987. Okay, so before you move forward, you will have to like bring this 21,773 out to save you stress of checking. Then for the fourth depreciation as well, you will have to write CA here. Then for the first depreciation, how do you get it? Year 4. Then you apply your 28%. Okay, you apply your 28% to what? To the new carrying amount, which is to 55,987. So 28% of 55,938, we have to give you what? 15,667. That's approximation. So when you deduct this 15,676 from 55,987, what do you have? You have 40,311. So before you move forward, you have to bring out the depreciation, okay, which is 15,676. Okay, so now for year 5 now, you can now get the final depreciation. Okay, so you apply it to your what? The carrying amount. So depreciation, so of 28%, apply it to this. So when you say 28% of 40,311, what do you have? You have what? 11,287. So you deduct it from this 40,311. What do you have? You have what? 29,024. 29,024 naira. Okay, so before you close, you will have to do what? You will have to bring out this depreciation. 11,287. Okay, so now this is the final depreciation, the 11,287. Then this one is supposed to be the what? The residual value. Don't forget, our residual value is what? Is 30,000 naira. We are supposed to have 30,000 naira here, but due to approximation error, we are not able to get our 30,000 naira, but you must get something very close to this 30,000 naira. Okay, so approximation error. So now we are moving to our last question on the section 1 of depreciation, which is when there is a revision of residual value and or there is a revision in the useful life of the assets. Okay, so now which is the question number 4? What's the question? The question says Software Co bought an equipment at a cost of 200,000 naira with a useful life of 5 years and a residual value of 10,000 naira using the straight line method. At the end of the year 2, the useful life of the equipment went down to 4 years and the residual value was also reviewed to what? 5,000 naira. So calculate the depreciation till the end of the year. So this is the requirement. So you have to calculate the depreciation till the end of the year. So brief explanation on this will be, for the first 2 years, okay, you apply the normal question, that's before the revision. Okay, you will apply it before the revision. Then after the revision, you will now apply the reviewed amount, okay, to getting your final 2 depreciation for the final year's depreciation. That's the other remaining 2 years. Okay, so now let's solve. Now based on the explanation, they said the asset is meant to use 5 years at a cost of 200,000 and with a residual value of what? 10,000 naira. They said this one will be maintained for just 2 years based on the question. Let us solve this question now, right? So we can now say, okay, the annual depreciation we have to be, you write the formula as usual, cost minus residual value all over the estimated useful life of the asset. So what's the initial cost? The cost is what? 200,000 naira. Okay, less the residual value of what? Of 10,000 naira. Over what's the initial number of years that the asset is meant to be used for? 5 years, right? Then you can now say 200,000 minus 10,000 naira. That will be what? That will be 190,000 naira, right? Over 5. So if you use your calculator in calculating 190,000 naira divided by 5, it will have to give you what? 38,000 naira. Okay, so now you know we are using this asset for basically 2 years before change. They change after 2 years, right? So it means before for the 2 years that they did not change, you will have to leave that one, then solve that one. So first, so this is the one they did not change. You will have to say 38,000 naira multiplied by 2. They did not change here. Okay, so 38,000 naira multiplied by 2, we have to give you what? 76,000 naira. So that's before change. So this one will now be depreciation for year 1 to year 2, or year 1 and year 2, the addition of the two together. So now let's now calculate for depreciation of year 3 and year 4. Why are we not considering year 5 again? Because they said it has been reviewed not to year 5, abi. They said they bring it down to what? To 4 years instead of 5 years, abi. So we are no more considering these 5 years again after the year 2. We will be considering 4 years after the year 2. And before, they said we should consider the residual value to be 10,000 naira. We are no more considering the residual value to be 10,000 naira, but we are considering the residual value to now be 5,000 naira. So now let's solve. So it will now be from year 3 now to year 4 will now be. How do you get the amount that will be remaining? That's the carrying amount that will be remaining at the beginning of year 3. You will have to say the cost is what? 200,000 naira, right? Then minus 76,000 naira. What would that give you? So that would be called the what? Carrying amount, abi. So the carrying amount we have to be equals to 100 and what? 124,000 naira. Okay, so now we have 124,000 as the amount which is standing for us now at the end of year 2, that is at the beginning of year 3. So we cannot apply everything, anything that we want to apply to this, we cannot apply it to it. Okay, according to IAS 8. IAS 8 means IAS 8 talks about change in accounting estimate, accounting policy and errors. Okay, so that is what IAS 8 talks about. So he said when there is a change like this, we call it change in accounting estimate. And change in accounting estimate, we have to apply solution to it. Okay, that is, you start from where it stops. Okay, the most available one is what you are going to use. So which is the best available one now? The best available figure now is what? 124,000 naira. So let us apply anything, any subsequent things that happen, let us apply it to this. So they said instead of you applying what? 10,000 naira, apply what? Apply 5,000 naira. So you have to say 124,000 naira. You review the formula again. So it will now be 124,000 naira minus what? Minus 5,000 naira, right? All over. So they said how many years is now remaining after you have exhausted your 2 years, right? You have exhausted out of 5 years. You have used 2 years, right? They now said it's not meant to be 5 years any longer. So it is meant to be what? 4 years. Okay, so it means you have used 2 years out of the 4 years. So what will now be remaining will be what? just 2 years. So it means it is now 2 years that you have to apply to what you have here. Okay, so 124,000 minus 5,000 naira. What do you have? You have what? 119,000 naira. All over what? All over 2. So 119,000 naira divided by 2 will give you what? 59,500 naira. So for each of the 2 remaining years now, you will have to have 59,500 naira for each of the years. So if you now want to calculate the depreciation for year 3 to year 4, it will now be 59,500 multiplied by what? Multiplied by 2, right? Multiplied by 2. So it will have to give you what? It will have to give you 119,000 naira. Okay, now based on the question, they said you should calculate the depreciation till the end of the what? Of the 4 years. What do? You have gotten the depreciation from year 1 to year 2 to be what? 76,000, and you have now gotten from year 3 to year 4 to be what? 119,000 naira. So you will have to add both of them together for you to get your answer based on the requirements. Okay, so for you to get your total what? Depreciation. So the depreciation for the year 1 to year 5 will have to be 76,000 plus 119,000 naira. So this will give you what? It will give you 195,000 naira. So which is the final solution to this? So now we'll be moving to the section 2 of this depreciation, where we'll be talking about the accounting entries. Welcome back to the section 2 of the accounting for depreciation. Now we'll be solving the question 5 of the accounting for depreciation. The question goes thus: HS Tutorial purchased an equipment for its office use at the cost of 120,000 naira on 1st of January 2012, and this asset has a useful life of 4 years with a scrap value of $30,000. HS Tutorial depreciates its assets based on straight line method on 1st January 2015. It was decided to increase the expected useful life by another 2 years, which is simply as a result of a better condition of the equipment, and the scrap value was also revised downward by $10,000. So what you are required to prepare here is equipment account, provision for depreciation account, profit and loss account up to what? 31st December 2015. Okay, so based on the explanation, they said the cost of the asset is actually 120,000, then the year is 4 years, then the scrap value is 30,000 based on the initial agreement. Then later at the end of 2014, that is the beginning of 2015, okay, they discovered that the asset, which is the equipment, is performing better. So they now increase the useful life of the asset by what? 2 years. That is to make up the asset to be what? 4 years. Then they revise the 30,000 naira downward by 10,000 naira. So this 30,000 naira will now turn back to be what? 20,000 naira now. So that's what they are saying. So if you are solving, so you will have to first of all get the first three question, the first three depreciation based on what? Based on the initial agreement. Then the fourth one, because it is actually 4 years that you have to calculate for, because if you calculate from 2012 down to 2015, okay, it is actually 4 years. So it means the first three we have to be based on what? The initial agreement. Then the fourth one we have to be based on the later agreement, which is this new revised ones. Okay, so now let's us solve. So what you will have to first of all get in your workings, okay, is the annual depreciation for the first 3 years annual depreciation. Okay, so you will have to say from 2012, okay, down to what, 2014. Okay, that's the end of 2014. So you have to write the formula, right? So they already said you are to calculate based on straight line method. So what you would just do is to say the cost, okay, minus what, the residual value, all over what, all over the estimated useful life. So what's the initial cost? The initial cost of the asset is $120. $120, okay, minus what's the residual value? $30,000. Okay, $30,000 all over what, the estimated useful life, which is what, initially 4 years. Okay, 4 years. So what do you do? So this one will give you what, $90,000, okay, all over what, 4. So what do you have at the end of that? You have what, 22,500 naira yearly. Okay, $22,500 yearly. So that will be your what, depreciation for each of the first 3 years now. Okay, from 2012 to 2014. So how do you calculate that? You have to say $22,500. Okay, multiply by what, 3. That will give you what? That will give you $67,500. Okay, so you have gotten for 2012 to 2014. So for you to get for the whole of 2015 now, what do you do? Okay, you have to use this revised question to solving it. So said still what you will not have at the end of this, okay, as your carrying cost now, it will be what, your new carrying cost. You have to be carrying amount. So it will have to be this cost, okay, this cost, which is 120,000 minus 67,500, the one that the depreciation that has already been gotten. So you just say $120,000, okay, minus $67,500. Okay, so we'll have 52,500 naira as our carrying amount. So this will now be our new figure, okay, which will adjust, okay, in order for us to now calculate our new depreciation. So let's adjust this now. So how can we adjust this now? You first of all apply the normal formula of the straight line method to it, which is the cost minus the residual value all over the estimated useful life. Okay, so it will now be, what's the cost? The cost is what? This $52,000 now, 500 naira, minus the residual value. What is now the new residual value? The new residual value will have to be what? 20,000 naira, since they said they revised this downward, this 30,000 naira downward by $10,000. Okay, so it will have to be $20,000 all over what? All over. Now the previous number of years that we have was 4 years, abi. So and they said they added 2 more years, abi. So we now have what? 6 years like that in total. Okay, so out of the 6 years now, we have exhausted 3. We have gotten the depreciation for 3, right? So since we have gotten depreciation for 3, so it means we have to have 3 on ground after we have deducted the 3 from the total 6. So the 52, we can now say $52,500 minus $20,000 will have to give us what? $32,500 all over what? 3. So $32,500 all over 3 equals to what now? It will now give us what? $10,830,000. So it means for 2015 now, the depreciation will be what? $10,833. So what do we do now? We have to do what? We have to add the whole of this, right? The 67,500 naira plus what? 10,833 for us to get the whole of the depreciation. So we can do that. Since we will still be solving this, okay, we should be able to get the addition in this provision for depreciation account. So now let's solve. So the first one they ask us to do is the what? The equipment account. Okay, let's open our equipment account. So instead of us using the straight line format of it, we have to use the T format. Okay, the T format better explain this. So let us use the T format, which is the ledger, the debit, then we have the credit. Okay, so now the first thing you will have to write, it is an asset. Okay, usually asset has debit balance. Okay, so then the cost of it we have to now be what? We have to be what? We have it in dollars, then to be what? 120,000. It must have a debit balance, so it will now be what? Cash. Okay, so that's for the first year, right? So that's 1 okay, 2000 and what? 2012. Then what do? This is not the place you apply your depreciation. You don't apply your depreciation in your equipment account. It is very wrong. Okay, so because whenever you are representing any cost of an asset, you have to spread it over its life. Okay, so except they sell part of this asset, that is when you will now deduct part of it. Okay, you are not supposed to touch it. If you want to solve for your depreciation, solve it in the depreciation account. So now let's move forward. So this will now be, you balance this. Okay, you balance this, balance carry down for the first year. So it will now be in dollars 120,000. Okay, balance it as well. Then the next one, carry this down as well, balance brought down, then $120,000. okay, for 1/1/2013, right? So balance what? Balance carry down. So it will now be $120,000. Balance it as well. Then bring it down again. So it will now be balance brought down. Okay, $120,000. So 1/1, okay, 2014. Okay, so then you balance it as well. So balance carried down. So this will be 120,000. That's how you spread it over the life of the asset. The asset is expected to use 6 years, so we are spreading it for 6 years. So it will be 1/1. The next one as well, 2015. Balance carried down. Balance brought down. Sorry, 120,000. Then you carry it down again. Balance carried down. Okay, it will be 120,000 as well. So you balance this. Then for the 5th year now, 1/1/2016. Okay, 1/1/2016. Balance brought down 120,000. Okay, then balance carried down will still be what? 120,000. The final year for it. It is not meant to get to this number of years. The reason why it is up to this number of years is because, initially they said we should use 4 years, right? They now revised it because they noticed that the asset can now perform well or better than when they bought it. So we'll have to add another 2 years. So that is the other 2 years we are now adding to it. Okay, so 17. Then balance brought down $120,000. Then you carry it down as well. Balance carried down. Then $120,000. So now, what is the second requirement? The second requirement said you should open the provision for depreciation account. So now let us open this account as well. Provision for depreciation account. So let us use this same T format, which is the ledger. So we did not use the vertical format or the straight format for it because we feel this one can better explain the debit and credit entry of it. So now let's move forward. So we can now say for this, where will this start? This one will start at the credit side because every depreciation must have a credit balance. Is that taken? It must have what? A credit balance. So this one will now be profit or loss. Profit or loss. What's the first year depreciation? The first year depreciation will have to be what? 22,500. So it is the 22,500 in dollars that you have to apply here. 22,500. Okay, 22,500. So that's 1/1/2012, right? So what do? You balance it here. Balance what? Carried down in dollars, 22,500. Then the next one, you have to bring this one down to the credit side. You balance it down here. Okay, so that's 22,500, right? So for the second year now, okay, the P or L account will still be what? Will still be debited by what? 22,500. So you credit what? Provision for depreciation account by 22,500. So what do you have here? You have to have 45,000 naira. This 45,000 naira, you have to balance it. This one will take place at the end of the year, so it will now be 31st. Okay, so you have to be 31st 12 of 2012. This one too will be 31st 12 of 2013. So balance carried down. Okay, 45,000 naira. You balance it again. You know, we are solving till 4 years because they said it must be up to what? Up to 31st December 2015. So you balance this 1 year as well. Balance brought down. The balance brought down will be what? 45,000 naira. Then the P or L accounts will as well be debited with what? With 22,500. With 22,500. So the addition of those two we have to give you what? 67,500 naira. Okay, so you go ahead to look to what? To balance it at the end of year 3, which is 34th of 2014. So that will be balance what? Balance carried down of how much? 67,500 naira. The total 67,500 naira. Then you balance this down now for the final one that we are going to do under provision for depreciation account. Okay, so it will now be balance brought down. The balance brought down will be what? 67,500 naira. Then the P or L account, okay, we have to be debited with what? With this final figure, which is 10,833. So you have to do what? 10,833. So when you add both of them together, what will it give? It will give you 78,333. So the balance carried down at the end of the 4th year now will be what? 31st 12 2015. So that will be what? Balance what? Carried down. The balance carried down will have to be 78,333. So 78,333. So now we can now record in the P or L account. Okay, so now I will have to open another account for P or L account. P or L account is profit or loss account. Okay, so which will serve as the corresponding entry of this P or L, P or L, P or L, P or L for each of the years. Okay, so what do? You just write for the year 1. At the end of the year 1 now, you have 31/12/2012. What's the figure for the depreciation? The figure is what? 22,000 in dollars, $22,500. Then you close it. Then the next one as well for the following year, it will be 31/12/2013. So that will be the depreciation, right? Depreciation, that's 22,500. Then for the fourth year, 31/12/2014, depreciation. Okay, still 22,500. Then the final one, which is 31/12/2015, right? So that will be a different amount from these ones that we have been having because there is a revision there. So it will now be 10,000. The depreciation, we have to be in dollars, 10,833. So we have come to the end of this class, which is the accounting for depreciation.